Hello everyone, welcome back to my YouTube channel. In the last class, we have solved one practical problem under direct method or asset account method using straight line method of depreciation. And in today's class, we are going to solve a problem under same method, that is direct method or asset account method, but using written down value method of depreciation, under written down value method of depreciation. So let's recall once the direct method or asset account method. This is the method of recording the depreciation. Clear? Under direct method or asset account method, depreciation is directly deducted from the asset account, and here means we reduce the value of the asset every year by charging the depreciation. And the asset balance in the balance sheet, it will always show its reduced value, that is net book value, that is opening value minus depreciation, opening balance minus depreciation. Clear? See, this is the direct method or asset account method. So let's solve the problem under written down value method of depreciation. See here, Mr. Rao purchased a machine on April 2020 for rupees 4 lakh and paid rupees 20,000 for installation. The machine is to be depreciated under the written down value method at 20% per annum. The books close on 31st March every year. Depreciation is charged to the asset account or plant or machine account. So prepare journal entries for 2020, 21, 21, 22 and 22, 23, means for 3 years we have to pass the journal entries. And second one, machine account for 3 years and depreciation account for the 3 years. So let's solve the problem. First here we have to find out the depreciation for all the 3 years, because here we are following the written down value method of depreciation. In straight line method, the depreciation amount remains same for the 3 years, but under written down value method the depreciation amount will change, right? So here first we need to determine the cost of the machine. Here purchase price 4 lakh and installation, that is rupees 20,000. So total cost of the machine is how much? Rupees 4 lakh 20,000. So for the first year we have to charge the depreciation on rupees 4 lakh 20,000. So depreciation how much? Written down value method at 20% per annum. So depreciation rate 20% per annum means here opening written down value, that is rupees 4 lakh 20,000. So 20% of 4 lakh 20,000, 84,000. That is our depreciation for the first year on 31st 3/21. So what is our closing written down value then? 4 lakh 20,000 opening written down value minus depreciation equals to rupees 3 lakh 36,000. That is our closing written down value. So for the second year, again we need to calculate the depreciation. For second year, opening written down value 3 lakh 36,000. Here closing written down value for the first year, see here 3 lakh 36,000, it becomes the opening written down value of the next year. You know, right, this one, that is rupees 3 lakh 36,000. Depreciation 20% of 3 lakh 36,000, that is rupees 67,200. Now closing written down value for second year 3 lakh 36,000 minus 67,200, that is opening written down value minus depreciation equals to rupees 2 lakh 68,800. Clear? Now for year third, here closing written down value of the second year, it becomes opening written down value of the third year, that is rupees 2,68,800. Now calculate the depreciation. 20% of rupees 2,68,800 equals to rupees 53,760. Clear? Now closing written down value, opening written down value minus depreciation becomes rupees 2,15,040. Clear? In this way, first we need to calculate the depreciation. After that, it's very easy to solve the problem. First, what we have to do? We have to pass the journal entries for 3 years. That is, on purchase, what is the journal entry? Machinery account debtor to bank account. That is including installation. That is rupees 4 lakh 20,000 being machine purchased and installation amount paid. And on 30 now we have to pass the journal entry for depreciation. depreciation account debtor at the year end, that is on year 21, to machine account, that is 84,000. See here we have calculated, right? 84,000 on 4,20,000, 80%, 20 percentage, that is rupees 84,000 being depreciation charge for the year 2021 under written down value method. Now what is the third journal entry? Now we have to pass this yes, depreciation, not pass, we have to transfer this depreciation to profit and loss account. So the journal entry is profit and loss account debtor to depreciation amount, that is 84,000. So now we need to repeat the same pattern for subsequent years from this only, this one depreciation, and we need to transfer depreciation again, we need to transfer for the third year. Again for the second year, depreciation account debtor to machine account 67,200 and transfer to profit and loss account. Profit and loss account debtor to depreciation account, that is rupees 67,200. This is for second year. And for third year again, depreciation account debtor to machine account, how much? Depreciation 53,760 and transfer to the profit and loss account. Profit and loss account debtor to depreciation account, that is rupees 53,760. See here. See, in this way we need to pass the journal entries. Clear? After journal entries, what they said, we have to prepare the machine account and depreciation account for 3 years. Now first we will prepare the machine account. This is the format of ledgers. See, machine account. See, go to the journal entries. First on 1/4/20 we purchase the machine account debtor to bank account. Here we have opened the machine account. Clear? Here machine account debtor to bank account. Here bank account, that is credited in journal entry. In ledger what we have to do? We need to debit. That's it. Clear? That is to bank account. Write down to bank account, that is rupees 4,20,000. Now let's check the journal entries. Yes, here one machine account is there, that is depreciation account debtor to machine account. Here depreciation account is debited. In journal, in ledger we need to credit, that is by depreciation account, how much? That is rupees 84,000. See here, by depreciation account 84,000. Now our balance carried on amount 4,20,000 minus 84,000 equals to rupees 3,36,000. Clear? This is our by balance carried on amount. So that is rupees 3,36,000. Now we have to close this years, means that is on 1/4/20 means first year's entry we need to close now, that equals to rupees 4,20,000. Now opening on 1/4/21 next year, that is to balance brought down, means closing balance of first year becomes the opening balance of the second year, that is 3,36,000. And now check the journal entries here. Sorry, on second year, here only is there, here. See here, on second year, depreciation account debtor to machine account 67,200. In journal entry, depreciation account is debited. In ledger, you need to credit. That's it. By depreciation account 67,200. Now there are no other entries. Just close the close the year 21's entries. That is by account, that is by balance carried on 2,68,800. Close the account of year 21. Clear? So closing balance of year 21 is 2,68,800. Now this amount, closing balance of second year, becomes the opening balance of third year, that is 1/4/22. To balance brought down 2,68,800. And again see here, 31st/3/23 depreciation account debtor to machine account. Here depreciation account is debited. So in the ledger of machine account, you need to credit the depreciation account, that is 53,760. And now close the account, that is by balance carried on 2,15,040. Now this becomes, means third year's closing balance becomes the opening balance of fourth year, that is 1,423, to balance brought down 2,15,040. But here we have to prepare the ledger accounts only for, or machine account only for 3 years. Clear? In this way we have to prepare the ledger accounts. Now machine account is over. Now go to the depreciation account. See here, on depreciation account, first year depreciation account debtor to machine account 84,000. Here depreciation account debtor to machine account. Here machine account it is credited. Now in ledger account we need to debit it. That is to machine account 84,000. And second one is by profit and loss account debtor to depreciation account. Here profit and loss account is debited. So in the ledger credit the profit and loss account by profit and loss account 84,000. Same for second and third year. Machine account 67,200 for second year, and for third year 53,760 the depreciation amount. Clear? In this way we have to solve the problem under written down value method of depreciation. Here under direct method or asset account, original cost is not shown permanently in the books. And each year depreciation is directly credited to the asset account, right? So the book value reduces year after year. And in the balance sheet what we have to do, the asset appears as its reduced value instead of original cost, right? So in this problem, see here, let's see year 20 and 21, the closing balance shown in the balance sheet, which amount we need to enter? That is rupees 3,36,000. Rupees 3,36,000. Here this amount 3,36,000 reduced amount. How it came? Opening written down value minus depreciation, that is 4,20,000 minus 84,000. That is 3,36,000. And in the year 21 and 22 we need to enter the amount of machine, that is 2,68,800. That is 3,36,000 minus 67,200. That is the depreciation. And in the year 22 and 23 we need to enter 2,15,040. The machine value becomes 2,15,040. So opening balance, that is 2,68,800 minus depreciation. So see, in the all three years in the balance sheet the asset appears as its reduced value. Clear? Instead of its original cost, reduced value. So here you need to remember, in the balance sheet the asset appears as its reduced value instead of original cost, whether it is straight line method or written down value method. But in the difference is, under straight line method the depreciation amount is same for all the years, but under written down value method the depreciation amount is going to change every year. Clear? So in this way we have to solve the problem under a written down value method. Here we have used the which method of recording the depreciation? Here we have used direct method or asset account. Direct method or asset account. 1 minute. Yes. Here we have used direct method or asset account for recording the depreciation. Clear? So I hope this problem is also clear to you all. In the next class we will discuss how to solve the problem under indirect method or provision or depreciation method or accumulated depreciation method. How to solve the problems under indirect method. If you have any doubts in this problem, please leave a comment. Thank you.